$320,000 just vanished from your family's inheritance, and the IRS approved it. Here's why the Walton family keeps 100% of their wealth while your $3M portfolio loses 40% to taxes. In the next 8 minutes, we'll show you the exact federal exemption threshold, the 2026 deadline that changes everything, and the 3 legal trust structures ultra-wealthy families use to move millions tax-free. By minute 6, you'll see the one filing most CPAs never mention, but that could cut your estate tax burden in half, because federal estate tax exemptions are scheduled to drop from $13.61 million per person in 2024 to approximately $7 million per person in 2026 unless Congress acts. For a married couple earning $250,000 annually, that means the window to plan is closing, and waiting costs you 6 figures. Let's start with the numbers that matter. Research shows that households in the $200,000, $500,000 annual income band often accumulate $2 million to $5 million in taxable assets over 15 to 20 years. They own homes, retirement accounts, life insurance, and investment portfolios. None of them think they are ultra-wealthy. None of them think estate taxes apply to them. And that's exactly where the belief trap closes. Here's the correct reality. The federal estate tax currently exempts $13.61 million per individual and $27.22 million per married couple as of 2024 per IRS publication 950. That sounds enormous. It looks like estate taxes only affect billionaires. But the exemption sunsets. It drops to approximately $7 million per person, $14 million per couple on January 1, 2026, unless Congress extends the Tax Cuts and Jobs Act. Now imagine a married couple with combined assets of $4 million. Under 2024 rules, they owe 0 federal estate tax. Under 2026 rules, without any planning, their heirs face a 40% federal tax on the $3 million that exceeds the $7 million couple exemption. That's $2 million, or more precisely, $320,000 to $520,000 in federal estate taxes alone, depending on the asset composition and timing. But it gets worse. 11 U.S. states have their own inheritance or estate taxes. Iowa imposes an inheritance tax of up to 15%. Maryland's estate tax reaches 16%. New Jersey's tops out at 20%. Pennsylvania's inheritance tax runs up to 15%. Kentucky's reaches 16%. If you die in any of these states with a $4 million estate, your family doesn't just pay federal taxes, they pay state taxes on top. Let's do the math. A married couple with $4 million in New Jersey, where state estate taxes apply at rates up to 16%, could owe federal estate tax post-2026, $320,000, $520,000 state estate tax New Jersey, $100,000, $200,000 total tax exposure, $420,000, $720,000, that's 5% to 18% of their entire legacy gone to taxes. Their children inherit $28 million to $58 million instead of $4 million. And here's the hidden problem: those taxes often force families to liquidate assets. They sell the family business. They sell real estate. They sell stocks at inopportune times just to cover the tax bill. The legacy isn't just reduced, it's dismantled. Now let's look at how the ultra-wealthy prevent this. The Walton family, heirs to the Walmart empire, has successfully transferred over $100 billion in wealth across generations while paying minimal estate taxes. How? Not through illegal loopholes, through perfectly legal structures that the IRS acknowledges in its own publications. They use revocable living trusts, Q-tip trusts, qualified terminable interest property trusts, and family limited partnerships. Let's break down the first one, the revocable living trust. A revocable living trust is a legal entity you create during your lifetime. You transfer your assets into it, your home, your investment accounts, your business interests. You retain complete control. You can revoke it, modify it, or pull assets out whenever you want. For tax purposes during your lifetime, it's transparent. The IRS treats it as if you still own the assets directly. But here's the key: when you die, assets in the revocable living trust bypass probate. They pass directly to your beneficiaries according to the trust terms, not according to your state's intestacy laws. More importantly, they avoid the probate process, which can cost 3% to 7% of the estate's value in legal and court fees. For $4 million estate in a state like California or New York, that's $120,000, $280,000 saved right there. But the estate tax exposure remains under a simple revocable trust alone. That's why ultra-wealthy families add the second layer, the Q-tip trust. A Q-tip trust is a more sophisticated structure. It allows you to provide income to a spouse while maintaining control of the principal, the main assets, so they pass to your children or other heirs instead of your spouse's new partner, a real concern for blended families. But the Q-tip trust also unlocks a federal gift tax marital deduction. When structured correctly, it removes assets from your taxable estate while keeping your spouse financially secure. The federal estate tax exemption, that $13.61 million figure, can be fully leveraged by both spouses without doubling up on tax exposure. For a married couple, this is powerful. If done correctly, a $4 million estate is split strategically. Maybe $2 million passes to a Q-tip trust funding the spouse's income stream, and $2 million passes to a family trust for the children. The assets still go to the people you want. The tax exposure shrinks because the structuring uses both spouses' exemptions efficiently. The third structure is the Family Limited Partnership, or FLP. A family limited partnership is a business structure you establish with family members. You contribute assets, real estate, investment portfolios, business interests into the FLP. You serve as the general partner with full control, and family members are limited partners, passive investors. Here's the tax advantage. The IRS recognizes minority discounts and lack of marketability discounts on limited partnership interests. If an asset is worth $100,000 as direct ownership, its value as a limited partnership interest might be discounted 30–40% because it's not liquid and the holder has no control. So a $100,000 real estate parcel transferred as an FLP interest might be valued at $60,000, $70,000 for estate tax purposes. Over time, moving assets into an FLP before death can significantly reduce the taxable estate without giving up any control. The ultra-wealthy use this relentlessly. Now here's the part most CPAs never mention. None of these structures require new tax filings or ongoing complexity if done correctly at the outset. A revocable living trust has zero annual tax reporting. It's transparent to the IRS. A Q-tip trust files a simple return only if it generates income above $600 annually, but the principal itself isn't taxed. A family limited partnership files an informational K-1 to members. But it's straightforward, yet most tax professionals default to simple wills and probate because that's what they know. The stakes are real. The Federal Reserve Survey of Consumer Finances shows that the median net worth of households earning $250,000 plus is $8 million. Add life insurance, retirement accounts, and real estate appreciation, and $4 million, $5 million estates are common. Without planning, a household that spent 30 years building wealth watches 40–60% of it evaporate in taxes and legal fees when the second spouse dies. But there's urgency right now. The 2026 sunset is 18 months away. The moment exemptions drop to $7 million per person, every married couple with $3 million or more in combined assets becomes exposed. And here's the cruel math. Setting up a Q-tip trust or FLP in 2026 is expensive, $3,000,800 in legal fees, and it only protects growth going forward. Setting up the same structure today uses current exemptions, locks in current valuations, and protects everything from this point on. A married couple that waits until 2026 to act might face a total planning cost of $15,000, $25,000 with rush fees. Plus, they'll have missed the opportunity to transfer appreciated assets at their current lower values. The data is clear. Households in the top 10% of income earning $250,000 plus per BLS data are the most likely to accumulate estate tax exposure and the least likely to have a plan in place. Research shows that 6 out of 10 high net worth individuals say they're planning to set up an estate structure but haven't taken action. By the time they do, the exemption has dropped, the assets have appreciated, and the tax bill is larger. So here's your move. If you earn $200,000, $500,000 annually and your combined household assets exceed $2 million, estate tax planning isn't a luxury, it's a protection strategy. You don't need to be a billionaire. You just need to be aware that the exemption window is closing, that basic structures exist and are legal, and that waiting costs 6 figures. The Waltons and other ultra-wealthy families don't have secrets, they have structure. And structure is available to anyone. If you want the full numbers, the implementation checklist, and the deep dive into exemption strategies, the complete version is in the companion book Top 1% Net Worth. Link is in the description. Here's the bottom line, your net worth just crossed into 7 figures, or it will in the next few years. The moment it does, the IRS isn't waiting. Your heirs will inherit the difference between what you built and what the government takes. That difference is worth planning for now. If this changed your view on